Good morning, Alan, Veronica. Happy Friday. We made it through another week.
Good afternoon, good evening. Good evening.
Good morning.
Let's get going here. Alan, you wanted to show some stuff about value versus growth and how that continues to outperform.
Yeah, basically, I just saw some interesting graphs that I thought I would share. I think everyone kind of knows that growth has outperformed value, and it's not just. You expect growth to outperform value. When growth is performing, it should outperform value because value is less volatile. So it's not a big surprise. But I think what has been a huge surprise is just the scale of what we're seeing, especially since the lockdown and the corona crisis of March 2020. So we can see the graph that Chris is showing there, that there's just a huge, if you just go back to March, April time where the graph goes down drastically, and then the bounce back really has been enormous in terms of growth. And okay, yes, in terms of value, yes, but it's not back up to where it was. And I think that's maybe an area where there is value in those value stocks. Maybe that's a good place to get in. If we look at the next slide, Chris, which is really interesting as a mirror image, so it needs a bit of explanation. So it's basically the weights, the sector weights, so underweight and overweight of relative to the MSCI World. So basically, if you look at it from the top, you're way overweight in financials in the value area, which is kind of you would expect. And if you look at the bottom of the graph, you're way underweight tech in value because there's not many IT names that are value names. They're all growth, right? And
so
then,
when you take value funds, you're going to end up with finances, utilities.
It's the top six, basically. Yeah, top 6 or 7, and a little bit of healthcare, but mostly it's consumer discretionary and IT is your growth story. And we've talked about the last few weeks, we've talked maybe the last couple of months about a rotation from growth into value. We are seeing that, we have seen that. But whether it's going to rotate back into growth or whether the value story is going to continue, that's the interesting scheme. The reason that I'm bringing that up now, and if we go to the third graph, is just the numbers that have been coming in over the last week or so for November. November was the best performing month, I think, Chris, you said since 1928 or something like that. It was something crazy on the S&P. This is a fund that we have, which quite a few clients will recognize, quite a few consultants will recognize, and quite a few people are in already. It's the Harmony Harmony US dollar growth. And if you just look at some of these are monthly figures. The monthly growth on equity, but even things like fixed income and real estate. These are just really, really crazy figures. And we've also talked about irrational exuberance, to quote Mr. Greenspan, is clearly these are not sustainable. This was a very strange month, a very interesting month of November. Are we going to see a pullback? We've seen maybe a little bit of a pullback, or we've seen a little bit of flatlining for, not surprisingly, over the last week or so. Interestingly, gold had a very bad month. Is gold going to come back? Possibly not. Doesn't look like it for the moment. I think you and I, Chris, watched this presentation by Ed Yardeni, who basically said that there's so many things that are deflationary. Gold isn't going to move anywhere. There's no inflationary impetus. So many things are deflationary still in the world.
What's interesting, an economist wrote a couple articles about that nowadays there is not much difference between value and growth investing, because we use just standard valuation tools, which includes like fundamentals and tangible assets. When we analyze company, we do not include the strengths of their brands or value of the intellectual property that, again, can be value investing for tech companies, value assets. So right now there is a big discussion between asset management, what we actually consider value investing, what we consider growth investing.
Mhm.
So that's can be different in the future.
I just on that one point, Ron, I just read something earlier about a fund manager, Jennison Global Opportunities Fund, and he mentioned that in Tesla, he saw a lot of Apple 2008, 2009 during the last financial crisis, where you were still having people lining up outside an Apple store to buy Apple products in the midst of a major recession. And he says Tesla has sold out during this crisis. And he makes an analogy, exactly what you said. How do you put a value on brand? I mean, if people are queuing to buy a product and selling that product out, that's got to have a value, right?
Mhm.
And talking about Tesla, we have several clients that kind of go into absolutely opposite directions. Some clients are interested in buying Tesla now, and some clients is just like, let's short Tesla because we expect 70% down. So what do you think, guys, Tesla is going to do? Let's look maybe at Tesla.
My opinion was in 2008 to short Apple. So I'm the wrong person to ask. I'm going to keep quiet on this one because my natural instinct is that Tesla is way overvalued and it should be shorted. There's no question about that.
Yeah, Tesla here is likely to pull back. Where it pulls back to, we don't know, right? Could pull back to the top of here, could pull to where it broke out. It could pull back all the way down to the 329 level, which is, if you look at percentage-wise, these are phenomenal. If it pulled back to here, this is, let me see. We have people that think there's a 70% downside. They're asking me to short with a 70% downside in this. And this is a 41% downside to bring it back to here. Bring it down to levels we haven't seen since June would be a 57% downside. 70% downside would bring it back way back in this range here. So I don't know where it's going to happen. I don't know what's going to happen here. If Tesla does come down that far, that means a lot for the S&P 500. I mean, that means I don't think Tesla will be the only company that's coming back hard. And the S&P 500 will fall dramatically, or should fall dramatically, if the Tesla's going to be that volatile and bring the market down. Which leads me to believe that people are, some of our consultants, friends, clients are getting bearish here and thinking this rally's overdone. I wanted to touch on
the whole thing. It kind of reminds a lot of people and analysts the end of the .com era, where especially 1999 when Yahoo jumped 64% at the end in December.
Yeah.
And just everything was on top, all these companies.
X.com never made $1.
Yeah, it might end up same way. So we're really cautious.
I mean, one of the themes has been oil, Brazil, and Russia. Obviously, those are all linked, but these have had very interesting. Last few weeks.
That's value plays right now. Yeah. Okay. So I wanted to show this graph, and I think it's kind of what Veronica was talking about, was reminiscent of what happened in 2001 and whatnot, when there was this, and we don't have that on the graph, but when there's a lot of deals coming through for mergers and acquisitions and IPOs. And so we have this IPO deals. This is just this SPAC ones, or the SPAC ones, where there's basically a blank check given to acquire another company and get on the market that way. But there's a huge amount of interest in getting an IPO on the market now. And I mentioned two we were watching this week were DoorDash. I don't know if I bring them up here. I don't see them, but DoorDash and Airbnb.
Airbnb.
Yeah, I mean, DoorDash, I think, was up over 100%, and then Airbnb was up the next day 120%. So these are huge moves in stocks that, yeah, they're worth what now, $100 billion. So
Airbnb is over 100, yeah.
$100 billion. DoorDash, I don't know, still a huge amount of money. And there's this ever flow of, if these companies are making that kind of returns in a day, why am I invested in Tesla, Apple? And so we saw some movement maybe out of that into more of these speculative names. And that's the froth you're looking for, is when people take what we consider already highly valued companies and take their money out and put them in even more highly valued companies and just trying to catch the dog's tail as it's zooming by you. You kind of worry about the overall excessive bullish behavior in the market. Still, if you look at the AAI index, it was at 65 this week again. So there's a lot of bullishness, and we talked about that last week. There's still a lot of bullishness in the market. Just in terms of some of the value stocks that we had mentioned, we do want to kind of pat ourselves on the back that we did talk about Pfizer way back when. Pfizer had a great last couple of weeks with the virus stuff broken out. We also talked about Pfizer is a value stock to me. These are healthcare, but this is like big name, Eli
dividend paying.
Yeah, dividend paying. It's just, look at Eli Lilly. I mean, Eli Lilly didn't come out with a vaccine. It had nothing to do with vaccines. It broke out this week. So we had the healthcare sector do really well, the big pharma sector do really well, and we also had our little friend AT&T, which we beat on and everything, and said, oh, this stock isn't worth anything, although it pays a 7% dividend. It was up 4% in one day, and then came back a little bit, and again up over 1% today when the market's fallen. So I think we've seen that rotation now, and I don't think the market's just going to give up here, even though Nasdaq had a
there's just too much money to be too much money that doesn't have anywhere to go.
Yeah, it's likely to rotate before it just sells off, and maybe we rotate out of Tesla and we rotate out of some of these crazy IPOs, and we find companies that make sense. And one of the big moves we had this week was in again oil and gas. So you saw some of these companies. I mean, we had a big move. This doesn't show it on this chart really, but there was a big move in oil again this week. If I can zoom in here, you can kind of see here that yesterday was a big move in oil, where it was up again 4% or something. So these types of moves where we think the economy is going to open up, things are going to get better. You don't need all this DoorDash. COVID companies, right? Tech companies and these stay-at-home companies are going to actually continue with their revenue output the way they've had, and that leads you to look at things that are actually what would work when the economies get back into more normal situations. And those things are what we talked about before, like metals and energy. And that's really, I mean, this metals chart still was on a rip this week. It's been on a rip since the vaccine. It's up 25% metals, not non-precious metal, but things like copper and stuff. So now we need to look at just in overall the market, what's going on. And we show these charts once in a while, but 9 months rolled over. But one of the ones that I think we really look at is when NYSE is going to roll over, and it hasn't rolled over yet. But look at where we are here. We're getting up to really extreme levels. And if you think we've got another month or 2 months ahead of good stock market with no volatility, you're really going to have to push levels that we haven't seen in a long time, and maintain. And this thing doesn't maintain these high levels for long. It does roll over. So this is a 5-year chart, put card. But if you go, I think back, we can go back way back, and you're not going to see put call ratios when they've hit levels of like 0.35. In other words, for every put being bought, there's 3 or more calls being bought. This is extreme bullishness. The number of stocks above their 50-day moving average looks like it's peaked here and it's coming down. That's one of the first signals we look for rolling over in the market. The number of stocks hitting new highs versus hitting new lows is way up here. I mean, I don't know if you can see some increases, but it's way up here. It's up above where we were back in pre-COVID, the fallout pre-COVID. So the end of the bullish period last winter. And I think just in general, we have to be careful that we don't get some more serious pullback than just a simple rotation from growth to value stocks. And I think that's what we're looking for. We did see a distribution day Wednesday on the market. We talked about IVD's distribution count last week. So that went up by 1. And I think we'll probably get one today. So if we look at the intraday chart on the NASDAQ, you see big sell-offs here in the end of the day on Wednesday. which led to a distribution day. You see another pretty decent sell-off, and there was a very small rebound at the very, very end of the day yesterday, but a sell-off overnight going into that day. And then today you had a very big sell-off in the morning, sell-off overnight, big sell-off in the morning, and kind of trying to get back to these low levels we saw on Wednesday, which, you know, if the market sells off like this and then you try to get a rebound and it's not really rebounding, and actually you're spiking here lower, this is kind of a market warning that there's really no more impetus for this market to go higher. And so we're heading into the last part of the year. The last part of the year is supposed to be super bullish. This thing has to turn around next week on option expirations and actually get bullish. We don't see that. We see more distribution days pile up. We're looking at a potential problem because how January goes for the year usually goes the year. So if we have a negative January, we have a collapse in the market in January. January is not bullish, and even the days around Christmas is the first signal. The days around Christmas aren't very bullish. Then we're likely to see a not great year for 2021, and that's got a correlation. What January does for the rest of the year is about 85% usually. So we're really in this time where the markets have to be bullish. You have to perform well, or you're going to have problems. And that's really what kind of we're watching out for. I'm not so concerned about like what happens in the next month or even few weeks, but I'm wondering about the warning signs that they have for the rest of the year, and how really the new administration in the United States is going to be able to affect these cross currents of possibly free money, which could lead to inflation. Although Yardeni doesn't see it, he does see it in asset prices. So the stock market is a big balloon here because of all the free money sloshing around. But what happens if inflation shows up like it did yesterday's CPI, where the CPI came in hotter than expected, and people thought, okay, maybe this is a warning sign. Will the economy run hot for a while, or will there be any inkling on the part of the central banks to say, look, actually, we may have to start raising rates, maybe not this year, but a year from now, or I mean, the minute that hits the market, that's going to change everybody's perspective. So right now, mortgages at around 2.5%, 30-year mortgage in the United States. When that goes up, the housing markets gets killed, and it's really hard to go lower from 2.5%. So I wonder. We've talked about, when Mike was with us, we talked a lot about inflation and the effects on the economy and how that would work out. And when I said it's too early to have these kind of conversations, well, I'm seeing kind of the beginning of what could be in 2021, the conversations about inflation, the conversations about the effects of so much free money. And that can change our talks here rather quickly, maybe in the second half of the year of 2021. I'm going to be doing a talk on Wednesday this week in Russian about how central banks view 2021, how investment banks view 2021, and how analysts and advisors view 2021. And I got to tell you, the preliminary work I've been doing is just all bullishness. It's like the market should be up another 20%, and everybody's saying that. When everybody's saying that and everybody's bullish, the hairs stand up on the back of your neck, and you're just like, wait, really, guys? If we're so certain it's going to be up 20%, and you already see this level of call buying, you already see these inflated IPO values, and you see this craziness, is it just going to be a giant melt up? And that's what Yardeni is saying. It's just going to be a melt up until we see those levels that really are unsustainable. And right now I watched IBD's levels of distribution, and we're going to pull the plug. I'm going to be more bearish if this thing piles up with negative days. This is not a chart that looks very bullish, does it, Alan? I mean, like, you look at this and you think this isn't a very bullish chart for the NASDAQ for this week. It was pretty miserable. This is Monday morning. This is, you're down big, and you're down big because of one bad Wednesday, which we can't come back from. So that's what I see, guys. I think that's all I have to cover today. We did cover the value, the fundamental stuff. We did cover. There's a lot to talk about with Brexit, Alan, and I don't want to we should actually devote some time and do a special talk about that, right? I mean, you want to cover anything?
Yeah, it's difficult to cover in 30 seconds, but it's looking like it's a no deal Brexit, which means basically UK will go to trading on WTO terms with the EU, basically. They have signed a number of free trade agreements with Singapore, Canada in the last week, or two of the countries they've signed. But of course, the EU is the big trading partner. It's not at a huge difference on the pound and on the FTSE. I mean, pound is down a little bit. It said it fell off a cliff, which it did. If you look at it, it's quite a graph. But it's one. We're talking 1%, though. You know,
Yeah.
today,
Yeah.
or in the last 48 hours or something like that. It's nothing ridiculous. It's certainly not even back to 115, which is what it hit. 115 to the dollar, which is what it hit in March, approximately.
Yeah, it looks like overnight on Sunday it collapsed, and then it collapsed again a little bit on Thursday and Friday. But if you took
yeah, exactly. It was exactly that. So, but even the FTSE is down marginally today, and the FTSE's not been up. The FTSE's kind of flatlined for the last few years. So, I was pretty sure there would be a deal, but I think it looks now that there won't be a deal. Politically, it's very difficult for the Prime Minister to renege, which he'll have to do, to renege on his promises to the Leave voters. So I think it's going to be a no deal, and that's going to be pretty. Well, it could be serious ramifications. Time will tell. There'll be some contingency planning. EU's put forward some contingency planning, but
yeah, I was gonna say it's probably going to happen later on, because like right now you're in COVID, you're trying to vaccinate your own people. There's not a lot of travel. Things are kind of slowed down. You don't really see the effects of taking a booming economy and then throwing it in disarray, right? You're already in disarray, so adding a little Brexit to it isn't really, just dressing on the salad, right? You're just kind of a mess, anyways.
There's not a huge amount to talk about. I mean, that's where we are. That's what it is. But it's very difficult to kind of predict exactly how bad or not it's going to be right now.
All right. So good Friday to everybody. We'll see you next week. Have a good
we'll
weekend.
see you on Wednesday. Actually, we'll talk about outlook for 2021, and it's going to be an hour discussion at 8 p.m. on Wednesday in Russian, if anyone wants to join.
Yeah, it's on our website, and there's a time web kind of link there. You can sign up for a ticket if you want. Okay. Thank you very much for watching, everybody. And
on Monday.
Oh, yes.
Okay.
All right. See you.
Take care.
Bye.